As someone who reviews funding files every single week, one of the most common situations I see is a business owner who just launched or is about to launch, sitting across from me with a great business idea, real hustle, and zero idea how to actually fund it. Because the advice they get online was either too generic or flat out wrong for where they're actually at. So let me give you the real version. Not the go apply for an SBA loan version or go take my course on how to stack credit cards version. The actual breakdown of what works for brand new businesses based on what I see getting funded week in and week out. The tools, the exact qualifications for each one, and the honest picture of where you need to be headed as the business grows. There are 5 tools for startups. Let's go through all of them. Before I walk you through each tool, I want to reset how you're thinking about this. When you're a brand new startup, funding is not about finding one magical source of capital. Your credit profile, your assets, your verifiable income, and your entity structure. These are all things that play a big part in figuring out which program is best for you. Every week, I talk to founders who are trying to force the wrong tool because it's the one they heard of or they watched a video of. That's how you waste time, take unnecessary credit hits, and end up in the wrong product. My job right now is to show you all 5 doors for startups. Your job is to figure out which one you should actually be walking through. Tool number 1, SBA Startup Loan. I'm starting here because every new business owner asks about this one first, and I want to be straight with you about what it actually takes. SBA Startup Loans are real. I've helped close them, but I will tell you right now, this is the hardest startup funding option on this entire list that I'm about to roll through. When there is no business history to underwrite, the lender has absolutely nothing to fall back on except what you personally bring to the table, and that bar is high. It usually consists of credit, collateral, and experience that are necessary to get approved. Qualification requirements for startup SBA loan are, like I said before, strong personal credit. We're generally talking 700 or above. Number 2, relevant experience. You need to have owned or managed a similar type of business before. A lender needs to see that you are going to know what you're doing in this industry. Number 3, liquidity. Real cash reserves or liquid assets. They want to see that you can survive a slow start without immediately defaulting. 10% minimum is the down payment on the SBA startup loan, and that is usually not a negotiable amount. Number 4, assets with equity. Collateral to secure the loan if the business doesn't perform. And number 5, a business plan with financial projections that actually hold up when someone who does this for a living reads them. When all of that is in place, the SBA startup loan is the best structured financing a new business can access. Long terms, low rates, government backed. There's nothing else in this category that comes close. But that's exactly why it's very difficult to qualify for, and lenders don't hand it out freely. If your situation doesn't check most of those boxes today, that's not a dead end. You can still find funding for your business because where there is a will, there is a way. It means that you fund with a different tool, and maybe come back to this one when you're actually ready for it. Tool number 2, 0% APR Credit Stacking. This is one of my favorite tools for the right candidate. And I say that as someone who reviews these files every week and sees exactly when it works and when it doesn't. Here's a situation where this shows up. You have a great personal credit score, but you don't have updated tax returns to verify your income. Maybe you just launched. Maybe you're transitioning out of a W-2 job. Credit stacking solves that problem. When you do not have verifiable income and you have good personal credit, this could be the best program available. What you're doing is applying strategically across multiple credit card issuers that offer 0% introductory and promotional APR periods. sometimes 12 months, and sometimes up to 24 months. When you get approved across several of them, those lines stack into a pool of interest-free capital. I've seen founders put together $50,000 to $300,000 or sometimes more this way. 0% interest, no interest charges during that window, and no business income verification documents required. Here are the qualification requirements for 0% APR credit stacking. 700 plus personal credit score, at least 2 years of established credit history. Your current credit card utilization must be at 30% or below. If you're above this, get it down before you apply. No tax returns are required. This is evaluated entirely on personal credit. W-2 income or personal income may help, but business income and the personal income documentation is not fully needed. The reason that I recommend this product to founders is because you don't need any income verification documents to qualify. No bank statements, no tax returns. If you've got good credit, you can get qualified for this program. Now, here's the part where I see a lot of people get into trouble. The 0% window is your runway. When it ends, the rate resets often to 16, 18, sometimes as high as 29% on a compounding basis. You need a plan for how you're deploying this capital, what return it generates, and how you're paying it down or transferring the balance before that clock runs out. Use it with intention. Don't treat it like free money with no consequences, because you will need to start paying it off eventually, or you'll start to rack up major interest costs. Tool number 3, personal term loans. Personal term loans are exactly what they sound like. You're borrowing in your personal name and using that capital to fund the business. No business history, no business tax returns needed. The underwriter doesn't care about your business entity at all. They care about you, your credit, your income, and your ability to repay as a borrower. We fund these regularly for founders in the early stages because they're clean programs. They're fast, and if those founders still have W-2 income, they can qualify extremely easily. They also don't touch the business credit profile. But I want to be direct with you about the trade-off. This debt lives on your personal credit and affects your debt to income. If your business hits a wall and the revenue doesn't come up the way you projected, that loan doesn't go away. That's why I always say only borrow for something specific with a measurable return, regardless of the program. I've seen too many founders use personal term loans for vague startup costs and end up with personal debt and nothing to show for it on the business side. That's why, regardless of what program you go with and what it requires, you should have a business plan for your own general reference. Here are the qualification requirements for personal term loans. You need a minimum of a 660 personal credit score. Income verification is required. W-2 pay stubs or personal tax returns. Most show personal income above $40,000 a year. The ones that I see actually qualify at least. You don't need any business history or business tax returns either. The typical terms on these programs are 3 to 5 years. Some of them even go as high as 10 years. All of them have monthly payments, and pretty much 99% of them have simple interest terms, meaning there are no early prepayment penalties. The earlier you pay them off, the more money you will actually save in interest. So the income floor here, it matters. And I'm not going to sugarcoat it either. If you're making less than $40K personally per year, most lenders are going to decline you. The debt to income math doesn't work in their underwriting. Above that number with clean credit, this is one of the fastest paths to capital that I have available for a brand new founder. Another thing that's worth taking note of is that because these are reporting to the personal bureaus, every on-time payment you make is actively building your personal credit profile. It's not just capital, it's a credit building tool if you use it the right way. And what that can allow us to do is transfer the outstanding personal debt over to the business once your business has actually started generating some revenue. Tool number 4, Vendor and Supplier Trade Lines. I want to be upfront about what this tool is and what it isn't. It's not going to put cash in your account this week. What it's going to do is build the credit infrastructure that every other serious financing option on the business, conventional business credit, SBA loans, private business lending, is going to require before they will say yes to you. And I'll tell you this from reviewing files every week. The founders who skip this step in year 1 are the ones calling me in year 2, wondering why they still can't get a business line of credit or a more suitable funding program. The ones who do this from day 1 walk into the bank ready. Here's how it works. You open accounts with vendors and suppliers who report payment history to the business credit bureaus, Dun & Bradstreet, Experian, and Equifax Business Credit. You go with vendors that actually sell stuff that you need, and you buy on the business credit what the business actually needs to operate. You pay on net 30 or net 60 terms, meaning that you can borrow and buy the goods on credit through your new trade line and then pay them back within 30 to 60 days. You can pay early whenever possible, and that behavior will get reported and build your paydex score on Dun & Bradstreet, which is something that a lot of lenders look at. Your IntelliScore will also get built, and ultimately your FICO SBSS score, which includes personal and business credit, will get built as well. Those are the conventional scores that lenders and SBA underwriters are usually pulling when they evaluate your business credit profile. Here are the requirements for vendor and supplier trade lines. The business entity must be structured compliantly. The registered LLC or corporation with a legitimate physical address. EIN on file and completely separated from your personal social security number, meaning you need an EIN letter, and it needs to have the business address on there along with the business name. Business bank account in the entity's legal name, meaning that you need a business checking account, and it needs to have your business's name on the top left of the statement. Next, entity information must be consistent everywhere, and this is the part most founders skip. But you gotta make sure you have the same legal name, the same address, the same business phone number, and the same @yourdomain email across every registration and bureau filing. The cool thing about vendor accounts is that there is no minimum credit score required to open the initial vendor accounts. You can get access to tier 1 vendors without having any history. I talk about entity compliance on almost every call I take, because I see it kill deals constantly because most founders skip that part. If your address on your Dun & Bradstreet profile is slightly different from what's on your bank account or Secretary of State filing, if your legal name has even one inconsistency across registrations, if you're using a personal cell phone as your business phone number instead of a dedicated business number, automated underwriting systems flag that. Not because the business is bad, because when things are inconsistent and the profile doesn't line up, that looks like risk to the underwriter. Fix it once from the start. It costs you almost nothing, and it pays dividends for years, sometimes decades. All right, let's get into the last one that we have been funding a ton of recently for both established businesses and startups. A HELOC, or a home equity line of credit. Tool number 5. If you own a home with equity in it, I want you to pay close attention to this one because in my experience, it is the most underused tool on the entire list. Most business owners either don't think of it or they assume it's a complicated process that takes forever. Neither of these things are true, especially with the way that we do it. A home equity line of credit lets you pull from the equity that you've already built in your home or the asset. The rate is tied to prime, which means you're getting capital at a cost that no unsecured personal loan and certainly no alternative business financing product can come close to matching. And here's what makes the way that we do this different. We can close a HELOC using bank statements alone and online appraisals. No tax returns required. our HELOC programs can close in as little as 3 days. Qualification requirements for a HELOC or a home equity line of credit are as follows. The home equity needs to be available. We can't get a HELOC on a property that you just purchased the other day. We lend up to 85% combined loan to value, or CLTV, depending on your credit score. This can be structured as a first, a second, or in some states, even a third lien position. Bank statements are accepted. No tax returns are needed to document your income for specific sort of HELOC lenders. For most conventional lenders, you will need tax returns. The funding for our HELOC program is in 3 to 5 business days in most cases. There is also no business history required. This is secured by the property, and the business's income can be used for income verification purposes. But another thing to note is that your HELOC needs to be used for business purposes if gotten through us. Let me show you the math on the CLTV so that this is concrete. If your home is worth $500,000 and you currently owe $250,000, we're looking at 50% LTV on the existing mortgage, or loan to value. At 85% CLTV, combined loan to value, you could potentially access up to $175,000 in a new line at a prime base rate plus a few points. Compare that to what a MCA or an unsecured personal loan would cost you for the same amount. There's really no comparison. The bank statement option for these HELOCs is something that I specifically recommend to business owners who have been aggressive with write-offs on their taxes, which can be the right tax strategy at times, but it makes your documented income look artificially low to a conventional lender. Your bank statements show what's actually flowing through. That's the real picture, and that's what we underwrite against. 3 to 5 days to get funded. When a real opportunity shows up and you need to move, that matters. And these rates are anywhere from 7 to 14%. Without any prepayment penalties. I'll say this clearly because I say it to every client. Your home is the collateral. This tool deserves the same intentionality you'd bring to any major business decision. Use it for specific investments with a clear return and a clear repayment plan, not vague working capital with no defined purpose. Every tool I just walked you through is a starting point, not where you stay. The goal I have for every founder I work with as a startup is the same. Use early stage capital intentionally. Build the entity and the credit profile correctly from day one. Then focus on growing your cash flow. Stack your time in business. And as you do those things systematically, you will graduate into conventional business credit and private business financing at better rates, longer terms, and higher amounts. Somewhere around 12 to 18 months in, with consistent deposits in the bank account, with vendor trade lines that have been reporting clean payment history across the bureaus, with a paydex score that actually exists, preferably one over 85. The doors to business lines of credit and SBA-backed loans and private business lending start opening. That doesn't happen by accident. It happens because you structured the entity right, because you kept the personal credit clean, because you put early capital into things that actually grew revenue and profitability, because you paid every vendor early and treated every line item on your credit report like it was going to matter in your next underwriting review, because it is. And if you're watching this video to this point, you must be somebody that cares about getting cheap money, so good on you. The most important next move you can make right now, regardless of which of these 5 tools applies to your situation today, is getting clear on exactly how the business credit gets built. I put out a dedicated video on that, and I'm linking it in the description, because that's the foundation your entire funding roadmap is built on. Everything I walk through in this video, the qualifications, the sequencing, how to think about capital at early stage, is laid out fully in my book, The Hero's Journey to Capital. Chapter 5 covers startup funding specifically, including how to map your funding roadmap from where you are today to where conventional and private business financing becomes available. Link is in the description. If you watch this and you're trying to figure out which of these 5 tools actually fits your situation right now, your credit score, your assets, your income, your entity, that's exactly the conversation my team and I have every single day. We review your full picture and tell you honestly what's open and out there and what the next best capital move is for your business. Book a free call with my team to see what options are best for your business at the link in the description. Subscribe for new content every single week on funding strategy, business credit, and how to build the financial foundation your business actually needs. Thank you so much for watching, and I'll see you guys in the next one.